Hey everyone. If we haven't met before, I'm Alex Norman. I'm the co-founder of TechTO. I'm an operator with two exits. I've done professional services. I'm an active investor as the head of Canada for Angels and partner at N49P. I'm so glad you joined us for this latest episode of Founders and Funding. The goal of this series is to help demystify the fundraising process and the relationship between investors and founders. Today we have a special edition with Laith from Silicon Valley Bank and Matt Roberts from ScaleUp Ventures, where we're going to go into the current investment trends and environment in the Canadian ecosystem. We're going to go deep into what's going on, what you should know as an early stage founder. But before we do that, if you haven't participated in our live recordings before, there's a lot you can do on the screen. One, on the side of your screen, that way you can see there's an ability to add comments and chat. Feel free to put any questions, interact with the audience, and we'll try to bring your chats into the conversation. If you want to be a bit more passive, but give us support, you can use the emoji cannon here to, give us a thumbs up, tell us what you think, that you're thinking, or as a team changes, react to what's going on. After the event, there will be a networking session. And if you've learned anything interesting, we'd appreciate that you share it with the wider tech community by sharing the tidbit using the hashtag TechTO. Now, let's get started. Love to get Matt and Laith on stage. Hey,
Hello. Hey, Alex. How are you?
I'm great. How are you?
I'm doing well, thank you. Hey,
So,
Laith. Finally got on there, eh?
yeah.
Oh yeah. Oh my God.
So Laith, just the team tells me we had some technical difficulties. It sounds like how'd you get over them?
Personal computer just completely circumvent the entire hardware.
And
But
so
yeah.
so maybe Laith, why don't you explain where you're at and whose hardware you have to circumvent?
Yes, that's a great lead-in. So my name is Laith. I work at Silicon Valley Bank. I'm part of the Canada team. I am the senior market development manager at the bank. That's a very long-winded way of saying I work with pre-Series A companies. I wear two hats at the bank. I work with the pre-Series A companies that I just talked about, but I also manage and lead all our partnerships and relationships with the different incubators and accelerators across the country. And then we also do a lot of work with a ton of different organizations that support founders. So working, for example, with Alex and the wonderful team at TechTO.
Cool. And Matt, would love to get an introduction. Other than being the expert of Canadian tech history tweet storms on Twitter, what else do people know
Yeah.
you about?
I'm Matt Roberts. I'm the one of the general partners over at ScaleUp Ventures. We do seed and Series A investing, though we're sort of late in our fund, and so we're in between funds at this particular moment, which gives me a great vantage point to discuss what we're going to do today, because I'm not actually in market, I'm watching the market. But we've done checks sort of starting in the sort of the $250,000 to $500,000 range up to 2.5 million. What we would term seed or Series A. I've been doing this in some form or another now for 15 years.
Yeah, so you've seen a few trends in this market.
I've seen many cycles here, so it's interesting.
Cool. So maybe as a background, let's explain a bit. Silicon Valley Bank historically has done these research reports that show the stage, the trends in the market. So can you tell us
Yeah.
a bit more about those reports and then how SVB has unique insight into what's going on?
Yeah, absolutely. So SVB has been around in the market for the past almost 35 plus years. Started out in Santa Clara and then expanded to 44 cities, 9 different countries around the world. As a result of being in so many different geographies, and as a result of having so many clients, we have about 25,000 25,000 clients, of which you've got around 3,000 to 4,000 venture capital and private equity firms. Because of that wide breadth of clients that we actually have, there's a lot of insights that we've actually learned between what's going on the funder side and what's going on the founder side. And as a result, we actually have a whole insights team based in San Francisco that every quarter actually gets together, talks to all the different branches, all the different countries, and actually tries to get both a qualitative and a quantitative sentiment on what's going on in the market. Then they go back, they do search through CRM, they do search through all the different sort of, your pitch books, your Gartners, your CB Insights, etc. And they come up with all these different trends that we actually end up seeing in the market. But it starts out with interviews at the local level with every single office. So yeah.
So it's very systematic. Matt, as a VC, how do you stay on top of the trends and know what's going on in the market? Because I imagine even when you're deploying capital, you don't have a team that can do that spans 9 countries and can do all this research.
No, and Laith used to be part of that team. Then he left me to go to Silicon Valley Bank, so there's even less people now to help me. The reality is that we spend a lot of time doing this, either meeting on Zoom now, slowly but surely coming back to coffees in the afternoon, and sort of getting a read on deals. You also are well aware of your people like Laith, your professional advisors and friends in the market, sort of sharing their knowledge. Your lawyers are also sort of giving you insights as to what they're seeing as new interesting terms that your competitors are adding in or taking out of term sheets to get them done. So you're generally sort of bird dogging, talking to lots of people, asking lots of questions, trying to see if you see a trend line in amongst all that noise.
Okay, so let's define the market we're talking about. So, when you hear early stage, what does that mean to you?
For me,
yeah.
So early stage for me is first handful of customers, probably no more than 10, certainly no less than 2 or 3, and a revenue relationship with those customers. So some sort of transactional, measurable transaction in financial means. So that can be dollars. That could also be a trial, but that's early to me. I don't do pre-revenue companies. I did initially do pre-revenue companies and learned very, very hard how hard that is. So I am no longer doing the pre-revenue type companies. I talk to customers.
Yep. And Laith, when you guys look at research, what is early stage for you guys?
Early stage for us is anything that is sort of a pre-Series A. So you're looking at anything from the companies that are coming out of accelerator, companies that are coming out of different programs, organizations, etc. And then kind of lines up with what Matt is saying. So they have a relationship with some form of customers, whether it's pilots or whether it's like fully on paid, like fully onboarded, etc. And then we kind of go from there.
Stage means this is not the Dapper Labs and Clear Codes of the world. I'm assuming those guys have good revenue. And right now, if you pick up a Global Mail, or I guess not pick up, but you read online the Global Mail, it seems like every week there's another $100 million financing in the Canadian ecosystem. That how does that reflect what's going on in early stage, or what are the trends you guys are seeing right now in early stage financing in Canada?
So in the earliest stages, we're seeing a bifurcation of deal flow. It's a tale of two cities. The deals that are easily done and the deals that take much longer to germinate. And that, I'd love to say that it's very easy to identify the attributes of those companies that are successful versus unsuccessful. But sometimes you just can't clearly delineate which ones will be. There seems to be seed deals that get done inside of 10 minutes in an afternoon, and then there are seed deals that take 6 months to get done. And it's perhaps network effects based, like who your network is and how you've sold into that network to try and raise your money. But some deals are taking much longer to germinate. There seems to be a lack of institutional seed capital in Canada. There's not a lack of angel money, but there's a lack of professionals doing this for a living. And then there seems to be a lot of interest in certain types of companies from all players.
And Laith, what are you seeing?
Yeah, so on the note, so to build kind of like what Matt kind of just mentioned, you're kind of seeing these deals that have been done in a very sort of short period of time. We saw that there was a lot of deals closing as soon as everybody went work from home, or during the pandemic, and we're still kind of in it right now. Most of the deals that closed lightning fast, we sort of dug in a little bit and kind of saw that some of them did have that really, really high momentum. Some of them were already closing prior to going work from home and prior to sort of like heading into this sort of pandemic. So they had already been in discussion. The deal was already happening anyways, and they were just sort of wrapping it up as you, so to speak. The other trend that we've been seeing, and to Matt's point on lack of institutional capital, especially at the early stage, I speak with a lot of founders. I meet with about 10 or 15 founders about a week. More and more founders nowadays are now looking to the United States for earlier stage capital. They're starting to look for earlier sort of VCs there. We're getting a lot of questions on like, hey, could you connect us to some of the players down in Boston, some of the people down at our offices with like New York or San Francisco, etc. It's just, I think there's a little bit of a frustration on the early stage founder side saying that, well, if there's no early stage capital for me here, I may as well go to a different market and try to raise. And then also we're in a Zoom or a venue world.
Yeah.
So basically I'm just going to do it remotely anyways. And if VCs are doing remote deals, then, then so be it.
Okay. I've got to unpack the two answers I just got because there's a lot of information there and a lot of questions I have. So I want to get back to US versus Canada, but first, what % of deals do you think are the quick, easy ones, the fast ones versus the slow ones? Because I think one of the frustrations founders have is they think everything's quick and easy. So if you're to guess ratio wise, like what % of deals happen quick, and is there any characteristics that you see that
1 in 20, perhaps maybe 1 in 10, if I was being generous, are super fast, and then the balance are significantly not. So you're not the attributes of the 5 and 10 are those who've worked in an industry that has had interactions with the investment community in some form or another. And they've either been a senior executive at a well-known startup and have leveraged the relationships they've gained with some of the board members there, or they are successful entrepreneurs in their own right and have had an exit at some point, or they have deep-seated technical knowledge of the industry or technology that they are choosing to commercialize, and have actually been priming the pump on their fundraise for a long period of time in advance of actually going to market to ask for capital. So they're usually reaching out to people like myself or Laith or others for 18, 24 months before they actually make an ask. And so the ask or the auction to raise their round to see whether all those friendly coffees were actually worth it takes it it's much more quick, right? Because those VCs should be presumably well aware of what the company and what the founder is going to be doing so that they can make a decision more quickly.
Like, anything to add to that?
I like that Matt used the word auction and then also was talking about the 18 to 24 months prior. And I remember that. I remember when I was at ScaleUp, Matt and I would meet with so many different founders over a very, very long period of time. And it's not sort of like a one and done sort of like static point in time where it's like, I need to fundraise, let me reach out to all the VCs and, close a round and then get back to work. There's a lot of relationship building. And it's something I think founders need to understand. It's just that it's not like I need to raise my round right now. Let me start reaching out to different VCs. It's like, I need to show that there's moving dots to my, there's progress, there's moving dots. There's like a build, there's velocity, there's direction, there's growth. And then when you actually build up all your relationships and you actually have your model proved out, then when you go and fundraise, you'll notice it's a lot shorter.
Interesting. And I see some questions coming in from the audience and we'll get to them. But like, I want to just summarize what I heard here. These fast rounds are like 5 to 10%. They are founders who have experience either at a larger company or experience in what they're doing. And they've basically pre-sold the deal or the company 18 months before they go raise. So it's I think what I hear, it's VC pattern matching. It's ability to invest in lines, not dots, which is a famous one out of Mark's sister. And my guess is these are also at a relatively higher valuation because it's a bit of an auction. Would you agree with that? I didn't hear either of you say that, but I heard auction. So do these rounds that go fast and only go fast but that raise more money or a higher valuation?
Wait. What you see founders doing is learning how to, if you think of an auction where there's some guy like ping pong paddle up in the air with a number on it sort of thing, how do you get those people who have the money to buy your art into a room? You presuppose and you reach out to them. So Sotheby's doesn't just let anybody, walk into the room. They invite them, and they invite them because they've been talking to them or seen them do things in other places. And they don't invite them piecemeal. They don't say, hey, why don't you come into the room? And then when wait for 2 days while I get another guy to come into the room. What they do is they say, hey, all of you arrive on this date. and they say this is what they throw out a catalog. They explain to you what they're going to be selling. They explain to what they're thinking about the pricing, and everybody sort of has a general zone of what this is going to look like when they walk into that room to do the auction. And then, and then the people who are more jazzed about it bid more, and they tend to be the people who get in. And that's what a round is predominantly, is a auction of equity to investors who have capital, right?
I love that description, because I don't think most founders realize that.
No, I think most founders think it is a network. Like, you get one and then it snowballs. You can do it that way, but it takes infinitely longer. And those are the rounds that you see taking much, much longer to close. Is when they say, all right, I'll get this one angel, and that one angel will unlock 10 other angels. And that can work. Don't get me wrong. Lots of things can work, but it's not the ideal scenario for trying to get your auction going, right?
Cool. I still have a lot more questions along this line, but let's pull up one of them. Let's pull up some of the questions from an audience. So, let's see. So like Ryan asks, what are some of the risk mitigation strategies you're using which consistently when investing in early stage companies? So I guess how do you look at building a portfolio? How do you determine what's the risk you're taking on? How do you think of that, is the way I'd rephrase it.
Well, you're handing, like, people seem to think that I'm in charge after I invest. I'd like to, like, as Laith knows, nothing can be further. But Laith has sat as my observer on several of my investments over the years, when he was working with us at ScaleUp, and we are not in charge. And so, up until the moment we send the check, we are desperately looking for what are the faults and foibles of our particular entrepreneurs, and what are their mistakes. And the reason for that is quite clear. You have to be a little bit crazy to start a company, to have the arrogance, perhaps, or the silliness to go out there and say, hey, I'm going to build something from nothing, and everybody else in the world has got something a little bit wrong, and I'm going to go correct that. It takes a little bit of something, right? And that something can also be a negative sometimes. Every entrepreneur has their successful attributes and their negative attributes. And we're just trying to make sure that we mitigate the negative ones. And we learn, that's what a good investment process usually teases out, is what's not great about this particular founder, right?
So can you give us an example of what's still investable, and then how you mitigate that?
So we invested in a company that not too long ago that has been on this particular TechTO, and I'm not going to mention the name just because I think it's a little bit. I want them to be able to tell the story in their own eyes and have their opinion here if we were to ever discuss it. But essentially, I led a round into them. They spent about a third of the money on a product that wasn't going to be successful. And what I learned, what we discovered was they didn't have clarity about actually who the decision maker was on their customers. So they were very good at talking to their users. They were forgetting to talk to the person who paid, right? And the person who paid wasn't the user in this particular case. And because of that, they were getting all this great feedback from the wrong person. And when it came finally time for us to see whether or not this was going to go, it didn't work. And had the founder been more in tune, I thought he was a great founder. I thought, hey, this is a great guy. He's constantly, him and his partner are constantly talking to the clients. They weren't the client that was paying; they were the client that was using. There was another client and what I learned is that their inexperience in that industry was what did it. And so since then, I've been adding this sort of portion. Like, you as a VC, you learn; as an entrepreneur, you learn. And now I spend a lot of time figuring out who is the purchaser in any sort of sales transaction that we go through from a due diligence point of view.
Interesting. And Laith, you were an the equity investor side. Now you're more, you provide debt, you provide other services. So again, from a SVB perspective, how do you guys look at mitigating risk in your?
Yeah, so with our venture debt products specifically, it's the most sort of frequent touch point. It's, I think, the most sort of popular product because it's the earliest, or one of the earliest products that we actually have. So when we're actually assessing risk, we're looking for signals from the different venture capital firms that are in that round, or that are taking sort of participation in that round. So we look for venture-backed companies primarily. So is Matt involved in this round? Yes or no? What kind of signal does that send us? ScaleUp, Omers, Real, Relay, and a couple others are, piling into this round. What do we know about these funds? Do we bank any of their portfolio companies? How are those portfolio companies performing? How are their overall funds performing? Do we know anything about the GPs behind the fund? Do we know anything about the partners as well? Have they run their own startups? Have they had a track record? Is there a track record? And then that's just on the venture capital side that's being involved in the round. And then we also do a little bit of due diligence on the founder themselves too. So yeah,
just a little bit,
just a tiny little sprinkle of due diligence. So we do a KYC check. We go into like the financials, projections, etc. But funny enough, when I was actually looking at the prerequisite lists between what we look at and what I used to look at ScaleUp, it was a very similar list, actually. There's a few sort of key differences around the financial statements, I guess, but overall, it was very much almost sort of completely overlapped.
There's a good reason why our due diligence list will look similar, but we sound like very different people. It's the fact that Laith is what financial services generally are, and what they have been for hundreds of years, which is taking somebody's money and giving it to you and charging you an interest rate. And no offense, Laith. And we're where there's a sort of a alchemy going on of trying to take debt and turn it into equity. So a venture capital firm is actually a line of credit in many ways. It's the way our investors measure it. It's a line of credit with an equity kicker, if you will. And so we convert a line of credit into equity into these companies. And because of that, we look at things very the same as the risk attributes of the company, but we don't look at it the same in terms of how the financial measurements should be done. And it's because we're not using it as an asset-based sort of loan, right? So that's what most people confuse. Institutional, when you hear about venture capital or angels, and then you hear about institutional venture capital, you got to remember, I'm where the conversion from a line of credit into cash into the bank goes, where there's no assets. That change is the risk premium that I charge everybody else. So I the reason why my capital is so expensive, and you'll hear that from lots of entrepreneurs, and I think it's fair, is because I have to pay back this whole loan plus an interest rate, plus I give 80% of the upside back to my LPs, right? It's because we're doing this conversion rate.
And just let's double click on your cost of capital is very high. So what does that mean for founders that aren't experienced?
So back in the olden days when I first started in this business, and I had more hair, if I gave you as an investor, if I gave you an investment, I would also probably put an interest rate on the debt, and that would be me transferring over to you the cost of my capital. So when I get $100 million fund, and I let's say spend it all in one afternoon, I have an interest rate on that. I have to pay. We call it a hurdle rate in our end of the business, but it is actually an interest rate that is to be minimum paid back to our investors, and that it hasn't changed dramatically. Although some of the more brand name VCs are getting away with no hurdle rate, but in general, it's historically been about 8%. So we take an 8% loan at $100 million. In my case, we're a $106 million fund. And then we have to return the fund plus the interest rate before we get paid out anything,
and cover your expenses as well.
And we have to cover the expenses. Like we get that 2 and 20. Everybody says, you get 2%, which in my $100 million sort of example here is $2 million a year. We think that's a lot of money. We actually have to pay that. It comes off. So it's actually, let's say it's an 8-year fund and it's 2% throughout the entire 8 years. It's usually not, but let's say my fund is actually now only $84 million. Of investable capital. The 16 goes to pay the people like Laith, who used to work for me, and myself, so I can eat. And then I have to pay an 8% interest. So you can start seeing where the economics get more and more complicated. And we're trying to squeeze that down into here's a check down to an entrepreneur. And don't cry for me or anything, because this is what I do for a living. I'm a former programmer, but I am now a financier. But we need to be correct about what's going on and why things are the way they are. So when you see institutional capital acting differently than perhaps an angel investment or or an angel investor, and everybody says, or even a smaller fund that hasn't taken any institutional capital because they're just a pledge fund, for example, where people have just pledged that they'll give money into every round. There's a very different economic base going on in the background, and entrepreneurs are well served to know what the economic base of their investors are all across the board. Like if you knew, for example, if you had an investor in Shopify and Shopify shares have gone down 50% next month, I hope they don't, but let's say they did, you knew your Shopify investors are probably not coming back for your next investment.
Yeah.
Right? Because they just feel poor, right? It's the same thing like, with VCs. Like if you know that the LPs are asking for these economics, somehow those economics are getting translated back down to you.
Yeah. So that's a good explanation of the cost of capital. Want to get back now to like that 95% that aren't having a quick round. And I'm actually going to wrap in a question here from Ryan, who's saying we're seeing more pre-seed rounds filled with entirely with angels and no leads. What is a consequence for those companies when they go to raise a seed or Series A? Do they have issues with, do you think getting an institutional lead for the next round? So I look at it, I'll reword this question. If you're in the 95% that aren't getting a quick round, how do you pull a round together? And is there a consequence if it's all like angels and there's no lead in that round?
Well, I'm looking at the guy who runs Angel List in Canada. So you probably know as well as me. Historically speaking, it has tended to lead to issues later when there hasn't been some professional investor of some type in the round to make sure things are kosher. Now, what those attributes are, it's a huge gambit. Like it could be anything, right? So I don't want to say that like angel-led rounds never translated to successful ones, because there's a network effect to angel rounds. So it depends very much on the cachet of the angels. If you have an angel network predominantly led by VC-backed entrepreneurs, they all know the score. They all know the game. They've done it once or twice, perhaps. So they've seen it once or twice, perhaps. So they have an understanding. They're not experts. I do this all day, every day. They do this on their weekends, sort of thing. But they do have a good idea of how to make sure it's not a disaster, and they don't want it to be, because they want the entrepreneur to successfully raise money on the outcome later on. So they're not. We used to have angels in Canada, we still do, who want to take over a company when they put their money into it. Those people are harder to find today. That's not because there's less of them. That's just because there's so many more good investors out there, and so I don't see it as a major problem. I have seen a lot of dilution being taken where entrepreneurs have just taken safe on safe on safe because they've never been able to find a third party to actually price their business. And then when somebody actually does, there's a moment of real pain because they suddenly realize that, what their company is worth. Somebody's actually put a price on it for the first time, and it really hurts their feelings.
So I'm going to jump in here. I think one of the things I tell founders, one round of safe, maybe 2 rounds of safe is okay. But after that, you're going to just have a bunch of upset stakeholders because no one actually ever maps out the cap table correctly. The founders don't, the investors don't, and everyone has less of the company than they think they had when that gets converted after.
So I'm famous for being the guy who prices. So I'm notorious in a good and a bad way, right? I have priced every round, every first check I've ever done into a company, with the exception of some early ones back at the beginning of my career, when I was not given the keys to the car, sort of thing. I've priced every single round. And that's not because I would never do a safe or I never do a convertible. I just prefer to align myself with what the company we think is worth today, have that hard conversation, and then move on from there. And some entrepreneurs choose not to go that route with me, and that's their prerogative. But I find that alignment is really good when you tell somebody, hey, I think your company is worth this. I'll buy this, and I'm going to help you create value on this metric, which is your equity share price. And then we both win or lose based on that particular alignment.
Well, especially because even if you have your pro rata, you're taking more dilution every round too. So you're actually aligned with the founders to create more value.
There was a reason we did safes, and it made a lot of sense when we first brought them into the market. They were predominantly they were around before, but they were made famous by our friends at YC, And YC did this because they were doing convertible notes before, which are a debt instrument, right? And it's very hard when there's a debt to close down a company if it fails. But it's really easy to close down a company on a safe if it fails. So YC is bifurcated too, slightly in the opposite direction. But if you don't raise a round after YC within 6 months, you're almost always a failed YC company. There's a small smattering of people that will say there's other examples and I know about them, but they're the minor ones, right? So if you don't raise money in 6 months after YC, you're a fail, right? And if you're a fail and you want to shut down and move on with your life, a safe is so much easier for you. So. Yeah. And so YC said, let's just do it that way because everybody does it within 3 months or 6 months. So let's just do that. Somehow that got miscommunicated, mistranslated into this is the new medium for getting money in an early stage company.
Yep.
And, that's just not what it was meant for. It was never meant to have safes that last more than 12 months. It was just not the thesis.
I'm going to actually see two other things founders think are advantages. One is you can just copy it off YC's site and use it, so legal costs drop. And the other thing is they can then do a rolling close, which goes back to, hey, you're taking 6 months. I can take a check today, a check tomorrow.
As you would know, Alex, and I think people should be aware of, YC and everyone else does a thing called side letters, which nobody mentions here because you see the safe and you think, oh yeah, that's what we use. But every single firm out there, lots of angels now, and even YC themselves have a side letter. And the side letter gives them extra rights that you would have gotten had you just done a price track. So it's kind of like silly to do a safe and a side letter because the side letter is where you'll spend all your legal dollars, right? And because the side letters are not necessarily standardized, they can run the gamut of what they asked for in there. There are some standard asks, but there are lots of weird things that you see in safe side letters, and then it can cost you more money than just doing a straight convertible note or doing a priced round sometimes. So it's safes are great, safes are fine, but they don't align capital to the outcome of the entrepreneurs as directly as me just owning the same share, more or less as the founder.
There's also tax consequences for investors, but we won't get into that right now.
There are tax consequences. There's a lot. We could get into the nebulous details of these things. Yeah. So we want to do that today.
So let's just, for me to be, what like you see this, you see lots of early stage companies coming out of accelerators and incubators you partner with. If you're one of those, again, in that 90% of founders that take 3 months plus to raise, what can you do to optimize or make sure that process is easier, less painful? What do you see in this current market that helps? Because I do believe you guys are right. It's a bifurcated market. BetaKit's going to write about the company that raised $5 million on a deck. Took them a week, but everyone else, it's frustrating. So if you're not lucky enough or positioned to be there, what is the advice you've seen? What are the current trends? What should you be aware of? What can you do to speed the process up?
Yeah, so I was actually just speaking with a couple founders earlier in this week on basically getting started on raising their rounds, and they were looking at the timing issue. So they were trying to figure out what time of year is actually best for them to best to start raising in. So obviously avoiding the dead period in summer, post sort of U.S. Thanksgiving or heading into the holidays, etc., that type of thing. So they were trying to figure out, first off, I'd say it's timing of the year, where you're actually, when you want to actually reach out to everybody. This is obviously, just a quick side note, this is obviously on top of the layering of you've already been building relationships, you've already been talking to people Matt, etc., around the city, and sort of keeping them sort of updated on how things are going. So that's one, is timing. Two, I think it's the thing that not a lot of founders and not a lot of folks in tech want to actually do, which is there's a manual part of this where it's who are the different investors that you want to reach out to? Why do you want to reach out to them? Is there a good fit? Why do you think there's a good fit in terms of stage, geography, thesis, no competitors in the portfolio? Are they still writing a check? How is their reputation? All these different things. And it's actually sort of trying to figure out how you can get the warmest and sort of the hottest intros in there. Obviously trying to go through a founder, a portfolio founder intro, or you're trying to go through a lender intro or a fellow VC, etc. There's a lot of sort of curation and a lot of sort of filtering down and really trying to build out a good high quality pipeline for investors. I did that exercise with the founder in the early summer. They came to me with a list of about, I think it was like 200 VCs. I walked them through some of the filters. Magically, the number went down to like 100. And I was like, all right, so which one of these actually will take a look at your company again, like in Canada, et cetera, the stage size, all these different things. Whittled it down to about, I think it was like 30 or 40. Of those 30 or 40, he went through sort of LinkedIn and was just like, you're connected to 10 of these. And could you make an intro to them? And we set up like a very curated, very short, succinct blurb as to like who this company is, why is it so important, why is there excitement around this, why I was actually sort of really trying to vouch for this founder, and we worked on those intros. Got about 8 out of 10 intros from the from the referrals, and just trying to like really give them sort of the momentum. So I would say figure out timing, figure out who you're going after and why, and really sort of curate that list. It's a manual process. There's no way around it. No one's going to automate it for you. And then really try to find those like quickest and best sort of value connections to there. I think those are my 3 pieces of advice.
And Matt, any advice from your side?
I would like, I haven't been on that side of the table. And so and usually they've already done a lot of this legwork before they get to someone like myself. But I will say that once, what I've noticed is the best entrepreneurs practice is that I'm never surprised that they're raising money now. Right? There's no surprise. Like, it's just like, okay, this makes sense. This is why you're doing this now. Right? It's people who surprise me are like, you're raising money now at that price?
Yeah, so,
oh my goodness, right? Like,
yes, I like that. That's actually a great question. That price, or that. So let's like, I think we have 5 or 6 minutes. So let's maybe try to do a few quick hits. Like, how do you like? And maybe these won't be quick, but like, what's pricing now? Like everyone thinks, like everyone hears again, Dapper just raised $7 billion. Well, how do you go price your company, and what do you see on pricing trends for early stage?
We are seeing more money going in at earlier stages. But the stages don't make any sense anymore. So let's just throw the nomenclature up, like seed, Series A, doesn't matter. So we're seeing more money going into companies that have less revenue profile, or less revenue, or no revenue at all. So we are seeing no revenue companies getting funded at much higher levels than I would have seen, 24, 36 months ago. I think COVID is part of an acceleration process of that what we've been seeing. It was not COVID that started this. It's that COVID accelerated it beyond belief. So what we've got going on here, those companies are either going to be massively successful for those entrepreneurs, or for those VCs who made those early bets, or it's going to be a disaster for them. It's one of the two. Since I don't do pre-revenue companies, I get to watch on the sidelines and get my popcorn out and just see what goes on, because companies that do perform will end up giving outsized returns to those VCs, and companies that do not perform, and i.e. don't get to a revenue run rate that can justify their revenue, or get a growth curve that shows that revenue curve is going to happen, will probably end up being failures for those VCs, and they'll become somewhat orphaned, and their economics will be very, very difficult to fathom for sort of a down round either. So it's going to be the tale of binary outcomes on those early stage bets where there's been significant capital. That doesn't mean that there's not going to be success there. There will be, but there's also going to be a lot of failure.
So I agree on that. Brett, so Laith, there's a question from Brett, which I think teases upon something you said earlier. So where's the best place to go raise money? Like, are Americans investing up here? Where should you be searching to raise your money from?
So that's a good question. And yeah, so I've been seeing more and more early stage founders start to look to the States for early stage VC money. Primarily, I've been seeing it happen around New York and San Francisco, depending on what your business actually tends to be. But for the most part, New York and San Francisco have been the main 2 sort of hubs where founders tend to sort of head. Back in the before times, before work from home, etc., I would see some founders basically book a one-way ticket down to Silicon Valley for like a couple months and just try to close out the round there. Some of them would be successful, some of them not. I mean, you're heading down to the States, thinking that this is my, silver bullet or magical solution. So do a lot of other founders. I think that's like the catch there. It's like you're not the only one that thought about this. The other issue is, yes, like if an American VC, invests in you at a higher valuation than their Canadian counterparts. To Matt's point earlier, what kind of strings attached, what kind of strings come along with the higher valuation, and what kind of requirements come with it. But back to Brett's point, it's San Francisco, New York. Those tend to be the main two. In Canada, it's the major cities. So you've got Toronto, you've got Montreal, you've got Vancouver, and then you've got some angel groups and angel investors running around in Ottawa as well that I've seen founders raise from.
So I'm gonna interject here. One thing, I think there's a big misconception with founders in the market. US VCs are looking more at the Canadian market, but it's still later stage. At the earliest stage, maybe for that 5% that can do quickly raise, I think the States is easy. But you have to think, if someone's writing a check into $1 million round from New York or San Francisco, they're going to have some social proof that the local ecosystem supports that founder, unless the space is extremely hot. Yeah. So at least that's what I've seen.
We all get phone calls. Like
Yeah.
Like after this, I'm in an hour or so. I've got a phone call, like 2 phone calls with the US based VCs who want me to give them the lowdown on deals that they're looking at here in Toronto that I'm not an investor in, but I know the founders fairly well. They're the social proof, you can say, or just like to make sure that these people aren't criminal. To some extent, or liars and things like that. Like, they're looking for a level of comfort because they can't meet these people easily now. So they will. That's what we see, for lack of a better term, party rounds coming together with no discernible lead investor. In terms of the capital outlay. So you might see a round led by a Real Ventures or a Golden. Insert premier Canadian fund here, but when you look at the cap table, you'll see that they actually weren't the largest check, perhaps, and they weren't the largest check because they maybe their funds are compared to our U.S. counterparts quite small, but they've been given an outsized level of influence because the American investor wants somebody on the ground locally that can check up on these people, these entrepreneurs and these founders more regularly. And so they sort of give them that, and that's new, during COVID, whereas before you used to see the US VCs predominantly try and if they were going to lead a seed round or a Series A round, they kind of try to exclude people like us. So there's been more collaboration. There's also a recognition that many of the US VC superpowers don't work in Canada. So if you look at a VC firm in San Francisco or Austin or in New York, they'll have all these great people that will help you build your business, and all of them have only ever done it in the US.
Yeah.
And so their network effects of, hey, I can help you hire your VP marketing. It's much more difficult to get them to translate that capital, that power up into the Canadian market. It's becoming less so, but their powers don't work up here so as much. So they have to have a local player. So they're looking for local partners that they prefer to work with.
Yeah. So once again, you should what I'm hearing is if you get someone local, then go to the States. It's probably better.
It is, or at the same time.
Yeah.
You should expect that somebody like me will get a phone call on somebody like you from somebody down there, because the network is pretty well. I'm on a board with dozens and dozens of US VCs, right? They all know me, and we've worked together, so they feel pretty. They're pretty happy to just give me a call and say, hey, what do you think?
They're not shy people.
No, not those guys. The European ones, yeah.
So I've got a few quick questions because we're getting up near time. One is, which trend in the current market do you think will continue, and which one do you think will reverse in the near future? So it could be market segment that's hot, valuations, anything that you think we're going to see more of, and one thing we're going to see less of.
Well, there you go. Laith doesn't know. Look at him. He's
I'm trying to.
I think we're going to see a pullback on some of the aggressive valuations we're seeing. And I say that not like that there's going to be a drop down to where we were 24 months ago, but there is going to be a level of pullback in terms of how aggressive this and speed to getting deals done. The tiger money will run out, and that seems to be the whip behind a lot of the Series A, Series B, Series C players right now. They feel sort of like that there's something chasing them, and they don't know where the lion is behind them, but they're all trying to run for that tree to get up into it. But what I'm very concerned about in the local Canadian market is a lack of seed capital. I don't know why I'm always the one on stages. I'm not on stage here. I'm in my basement, but on stages somewhere, moaning and groaning about this. We have less seed investors like GPs and firms in Canada today than we had in 2015 doing seed. Like I don't understand.
Moved up.
Everybody, yeah, and I can't begrudge them the economics of trying to run a larger fund and trying to do seed. It's very difficult to continue to provide value to entrepreneurs at a very from an institution at volume when you're a small team. So you have to raise larger funds. There's very few people who have found that niche and found a way to do it properly. I think version 1 would be probably the premier example of sort of finding that middle ground. But all the rest have had to go up market because the Canadian LPs have sort of forced them to, because of Vicky and VCAP and things like that. There is not enough seed investors in the market today doing checks between $500 and $1 million that will lead these rounds. I refer so many deals out there, and I can't find leads for these things. And that's the thing that worries me, is that we might have a moment where there's a gap in the market that's just too far for lots of great companies and entrepreneurs to jump.
So just to build on that, and in terms of what we're seeing in terms of trends is, so lack of capital on the seed side. I know we get the beta kit articles, we get the CVCA reports that say, we had a record, VC, quarter, we had a record VC year, VC dollars, invested in Canada, et cetera, et cetera. But if you look at the breakdown of stage, it's all Series A and up. You had I'll never forget the one that was I think it was a 2019 or 2020 report where it was just Q4 was a record, it was a record.
And it was 3 deals.
It was if you break it down and you actually do the math, it's 3 to 5 deals made all that money, and it was just great. But you have so many. You've got hundreds of companies out there that are that are looking for.
Yeah, if you look at one of the best examples is just look at Waterloo, which is I think in many Canadians' minds the epicenter of where technology is coming out of to some extent. And if you just look at the number of seed deals that are getting done each quarter, it is a pittance. It is really sad, and that doesn't translate into problems today. But 3 years down the road, where are all these Series A and Series B funds going to find these deals, right? And so, I question the ecosystem that we have right now quite a bit. I'm not in market right now, so I get to sit on the sidelines and heckle. But I really do wonder how we can I assume most of the people on this call are going to be early stage entrepreneurs and I don't see an easy path for 95% of them, right? So
so just side note here, I've been running $350,000 checks on my fund, and it's usually I'd say what traditionally we see, but it's now pre-seed, and that's and when my founders come to look for seed, I'm quickly introducing them to people in the States. Yeah, because there's 3 doors. There's 3 doors to knock on here. That's it.
It's very difficult for Canadian funds to compete in the Series A investments unless they have either a quality Canadian fund already in the seed or they did part of the seed themselves. Yeah, that's what I think the Canadian LP base, the people who give us money, they don't want to do seed GPs. Very few of them are willing to do that, and almost none. And so that's why all these funds are going up further up the food chain, because they can't get money if the LPs say no, right? So there's a problem, and I don't see a clear solution yet.
So I might pick your brain about that after this call or after this we record this. One last question, and someone beat me to the punch. I think it's what was that? Mahmood is asking, how can people get in touch with both of you? So maybe, what's your preferred Twitter? So what's your handle?
Matt Roberts.
Laith, and then Laith M. Shukri. That's literally it. So first name, last name with an M in the middle.
So for both of you, reach out to Twitter.
I think it's on my profile in the corner there. If you click on my
And so basically, DM you. They have a pitch. They have something. That's the best way to interact with both of you.
Yeah, my DMs are open. Like, just slide right in there, and we'll set up some time for things. So it's the easiest way for me to filter my system. Email is horrible. So just don't.
Well, yeah, I'm sure you only have like a few hundred emails a day.
Yeah, it's actually unfortunately a lot more than that for some reason. Yeah, I used to have Laith just go in there and clean it out for me. So.
Oh, Laith, if you offered as a service, I'd invest in that.
I know. I like Laith as a service.
There you go. Stop idea. Someone to go through our emails and clean them up. Thank you both. This was an extremely insightful conversation. I might go back. Maybe we'll carry it on Twitter in a bit because I think there's a few things that you've touched on, which maybe is a follow up in the next couple of days. I might just hit you guys up and spark a conversation. Because I do think the key to take away for me from a founder though is just because you hear of quick rounds, high valuations getting done early stage, that is not the normal. Even though that's what people think it is a slog. And the best thing to do is prepare for it and be organized. So thank you both for driving that home. Thank you for your time. Thanks, guys.
Thanks. Thanks, Alex.
Thanks.
Cool. If you want to stick around, in 2 minutes, we're going to have networking so you can meet fellow people in the community. And if you enjoy this and you're not a TechTO subscriber, you should sign up to our newsletter where we have 3 newsletters a week, which go through what's going on in the TechTO community, how to talk about your career, and what's going on in the tech Canadian ecosystem. We try to curate what's there. We put some analysis. We have some opinions. Just a good way to stay up to date what's going across the country. If you want to see past Founders and Funding episodes, we have them on YouTube, or you can listen to them as a podcast form when you're going for your run, or if you ever commute again. You can find them at Apple or Spotify or wherever you listen to podcasts. And finally, I love talking to everyone digitally. I love Zoom. I love Venue, but we're actually going back to live events. If you're in Toronto, we're having a live event on October 18th. It's going to be outside. It's going to be real life. You can find out more details at TechTO.org. Or if you're in Vancouver, we're having our first event there in about 2 years. We're going to be co-hosting with William Johnson. We're going to be having a couple firesides. And again, you can find out about that event on October 20th at TechTO.org. I hope you all have a great day. Thanks.